Joining me now in studio here is Seamus Smyth. He's a chief economist at Virtu's Investment Partners. Seamus, thanks for joining.
My pleasure.
All right, so let's get a scene setter from you in terms of where we are. We had some better than expected manufacturing data yesterday, but still some concerns in this market about the path forward.
Yeah, and I think that manufacturing data is going to fundamentally be a little bit lagging based on sort of what we're seeing on a going forward basis. I think when we think about the data more broadly, I think we have to sort of separate between what's backward looking, what's a little bit forward looking, and try to sort of parse how the data is going to flow going forward. And certainly we think that we're going to continue to see some robust data, perhaps some perversely robust data in things such as consumption, as there's some pull forward by consumers ahead of tariffs. But then beyond that, we probably get a weakening as we go forward. But it's going to take a little while for that to show up.
What does that mean for Fed interest rate policy as the central bank is set to meet on Wednesday?
I think it's a very complicated environment for the Fed. It remains a very complicated environment for the Fed as they try to think about sort of trading off between the inflationary impacts of what we've seen and the growth impacts. And the sort of flow of the data as we go forward is going to make it tricky. And I think they're going to do what they kind of said they're going to do. They're going to sort of watch the data, try remain on hold a little bit for now to try assess which is the bigger risk, the growth risk or the inflation risk as we go forward, and try to see what the data says about that. But that leaves us on hold, we think, probably through the summer.
How do you see tariffs and, of course, the rest of the factors here within the cycle impacting jobs and inflation?
So on inflation, I think tariffs are very clearly going to push up the prices of imported goods. And it's going to be, it's not going to be a game-changing one, but it's going to be significant. We're talking core PC inflation trending back up towards the 3.5% to 4% range. We're in the sort of 2.5% range, so a point to a point and a half on inflation. But that, given we're already a little bit above the Fed's target, that pushes us further above the Fed's target. Again, one of the reasons why the Fed is very cautious in the current environment, especially given we've just come through a pretty significant inflationary episode. So I think the tariff side works there. There's also, though, a real income effect on consumers. You basically have a large segment of consumers getting poorer from the price increases from the tariffs. That generally leads to a pullback in real consumption. That's what we expect to see, not right away, but later in the summer.
Interesting. And in terms of the jobs picture, we've seen the jobs market hold pretty steady. Of course, we know that DOGE has led to tens of thousands, if not hundreds of thousands, of federal government jobs reduced. Those haven't really shown up in the data yet. How do you expect that to play out?
No, and I think it's a little bit unclear because of so much of what's going on there is unclear. But a lot of the DOGE stuff was deferred separations from the government. So it's going to take a little while before that flows through into the data. In terms of the other side of the data, what we've seen so far at least is a slowdown in the pace of hiring, but not really any pickups in layoffs. And for the next couple months, I think that's what we continue to get. Our baseline is that we don't have a huge move in the labor market, but that's, again, one of the things that the Fed is watching very closely, whether you do get a more significant move in the labor market, whether you get the unemployment rate starting to move higher from the sort of 4.25% range where it is now into the 4.5%, 4.75% range. That's the sort of thing that gets the Fed off the sideline, where if you see that sort of weakening. Again, our baseline is we don't get enough of a significant weakening, but it's a very real risk and something we're watching closely.
It looks like in the wake of the recent data that markets are now pricing in a July rate cut from the Fed, pushing that back from the original expectation of June. Yep. Do you think that that's warranted?
I don't think we are going to have enough data, and I think that's also going to be when the bad inflation data is really hitting. So I'm very cautious on thinking that we're going to get a July rate cut, again, because of that inflation side and because of the lags that we're going to see on the real side. When we move into the fall and we sort of potentially see the price increases from tariffs having flowed through and then stabilized, and if it does look like there is that stabilization, then I think that opens it up for the Fed. I do think we really need to be cautious about pulling it forward too much given the significant increases we're going to see.
Interesting. So it sounds like maybe the fall is the first time that you would anticipate a rate cut.
Yes.
Yeah.
Again, unless the labor market deteriorates much more rapidly.
What other conversations that you're having with clients right now amid this environment, Seamus?
I mean, I think it is really just trying to understand tariffs, trying to understand when and if we're going to get any clarity on them, because I think that's one of the factors that is really important in thinking about it. It's not just that the tariffs are coming, it's that we don't know exactly what tariffs are going to be, which countries are going to be in, when they're going to be, and how long they're going to be. So firms are, I think, having a lot of trouble figuring out how to reorient their supply chains, thinking about how to sort of put in place the plans that they need to deal with these issues that are coming. And so I think that is going to sort of be a real issue as we go forward. You're seeing some signs that firms are thinking about pulling back their capex. It hasn't actually shown up again in the harder data, but it has in some of the softer data. And the capex plans that you see from regional Fed PMIs, those are looking notably softer. And so I think it's a concern.
What does this mean for equities?
I think for equities, I think there are some real risks, again, from the growth side. I think equities have been in an environment where we have had very solid growth for the past 3 to 4 years coming out of COVID. We're going to be looking at growth that is coming down significantly. Companies are going to face a choice between either having to push through price increases or take it out of margins. In a sluggish growth environment, it's not as good of an environment as we had seen. I think there's certainly going to still be selective value. I think there's going to be potentially interesting opportunities internationally as we go forward, but sort of the growth environment is just going to be slower.
How does the U.S. compare to what you're seeing internationally from an economic standpoint?
Yeah, so the U.S., I think the shock's a little bit different. For the U.S., it's a shock where you're pushing down growth and you're pushing up inflation. For most other countries, what instead you're seeing is a shock that pushes down both growth and inflation. So that sort of, we're talking about how it's a little bit tricky for the Fed. It's less tricky for other central banks. They can just cut rates because they have less to worry about on the inflationary side.
Interesting. We have UConn celebrating the opening bell behind us. We're going to take those remarks in the boardroom soon, but pretty impressive just the run that we've seen women's college basketball, women's basketball in general really have of late, especially when it comes to the business side of things. I'm not sure if you have any remarks on that, but certainly from a consumption standpoint, just the ticket prices, Seamus, that we've seen, I think show that there are pockets of the economy that are holding up in this environment.
Yeah, and again, I don't think we are really having seen the impacts yet. But yes, the economy going into this was very solid, right?
Yeah.
The economy going into this was not problematic. And as you said, you are seeing sort of generational changes in how sports are consumed and who consumes sports, and you're seeing the relative demand shifting for that.
Seamus, anything else our viewers should know here before we take those remarks in the boardroom?
No, I think we covered a lot of ground.
A lot of ground, that's right. And in terms of what you're watching most closely next, I'm sure the Fed decision, any other data points in particular?
I mean, I think it's really going to next be the inflation data points, how those flow through. I think, as I said, I think some of the data is going to be distorted on the growth side until we really get a little bit later into the year, into the summer rather, not the year.
Great. Seamus Smyth here in studio. Seamus, thank you so much for joining. He's the chief economist at Virtu's Investment Partners.